Hey, it's John from stopsaving.com and welcome to the next video in our course about technical analysis simplified. This video is on one of my favorite technical indicators and how to use it. We'll cover what you need to know about the relative strength index or RSI to help you answer a very important question. Who's getting stronger, buyers or sellers? So let's jump in. So here's what you'll learn in this video. Number one, what the relative strength index or RSI is and how it's calculated. Two, how you can use the RSI to gauge price momentum or the relative strength of buyers and sellers. And finally, number three, how to spot bullish and bearish divergences between the RSI and the price and how to trade them. So before we get into the technicalities of the RSI, you might be wondering who came up with it. Well, it's this guy right here, J. Willis Wilder Jr. Wilder was an American mechanical engineer and real estate developer. And if you've ever studied mechanical engineering or know someone who has, you'll know it involves a lot of mathematical formulas. So no doubt this came in handy when Wilder was building the relative strength index. In 1978, Wilder published a book called New Concepts in Technical Trading Systems, and that's when he revealed the RSI to the public. He also invented a bunch of other indicators, including the average true range, average directional index, and parabolic SAR. Now, these are all good indicators, but remember, in this course, we're trying to focus on learning the indicators that you need to know in order to up your trading game, rather than trying to learn every possible indicator under the sun. And in my experience, understanding the RSI can really improve your results. So on that note, let's now answer this question. What is the RSI and how does it work? Well, it's an indicator that measures the momentum of a trend. It can tell you if an investment is overbought or oversold. Overbought means buying might be excessive, and oversold means selling might be excessive. Put another way, the RSI measures the speed and distance of recent price movements to determine if buying or selling pressure has more strength. Now, the RSI is an oscillator indicator, and its value ranges from 0 to 100. When the RSI is above 70, it suggests the asset is overbought. And when the RSI is below 30, it suggests the asset is oversold. And in this video, we're going to learn how to use the RSI the right way in your strategy. So as I mentioned a couple of slides back, Wilder liked maths. And while you really don't need to know the RSI formula to use it in your strategy, it can be good to understand it. So let's dig into that. The RSI value at any point in time equals 100 minus 100 over 1 plus RS. Now, the use of the number 100 is just to make the index range between 0 and 100. So in this case, the RS value in the denominator at the bottom is what's really important. And that RS value is this: the average gain over the last 14 up periods divided by the average loss over the last 14 down periods. For example, let's say we were using days as the period in this case. Over the past 14 days, there might be 5 days where the price went up and 9 days where the price went down. So here, the average gain would be the average percent gain of those 5 up days, and the average loss would be the average percent loss of the 9 down days. And while you don't need to know exactly how to calculate the RSI, it's really useful to understand what the equation is saying. The first important thing is this: a bigger RS number means the average gains are bigger than the average losses, and this means the RSI value is closer to 100. In other words, buying pressure is stronger. And when the RS number is smaller, it's the opposite. Average losses are bigger than average gains over the past 14 trading periods, and selling pressure is stronger than buying pressure, according to the indicator. Now, as I mentioned earlier in the video, an investment is potentially overbought when the RSI is higher than 70. That means the average gains over the past 14 periods are high relative to the average losses. In other words, buy pressure is firmly in control. And again, an RSI below 30 means an asset is potentially oversold. The average losses over the last 14 periods are high relative to the average gains. That means sellers are firmly in control. So let's now look at a few examples of the RSI in action. And here we have the Bitcoin 1 week chart at the top with the RSI in blue at the bottom. Now, many people think that if the RSI is above 70, it means you should consider taking profits and selling because the investment is overbought. But as you can see in the grey shaded rectangles here, here, and here, the RSI can stay overbought for a long time before the price eventually comes down. In fact, you'd have pretty much missed out on 3 past bull markets for Bitcoin by selling Bitcoin when the RSI was above 70. So as you can see, the RSI getting above 70 is not necessarily a sell signal. And here's another example with Solana's Sol token on the 1 week chart. As you can see here, the biggest rallies happened when the RSI was above 70. So we've established that investments tend to stay overbought for a long time in strong bull markets. But when it comes to the weekly RSI being oversold below 30, it can, in some cases, be a good time to start buying into an investment. And here are 2 examples of that with Bitcoin on the 1 week chart. The 2018-19 bear market low happened when the weekly RSI got below 30 over here. But for the 2022 bear market, the RSI got below 30 before the ultimate low a few months later. Still, it would have been a good time to start gradually buying Bitcoin. Another option would be to wait until the RSI made its first higher low after going below 30. A good sign that buy pressure was starting to get the upper hand on sell pressure. We'll cover this more later on in this video when we explore the topic of RSI bullish divergence. So, buying when the weekly RSI is below 30 can sometimes be a good long-term strategy. But buying when the daily RSI is below 30 is a lot more risky. And we can see that here where I've circled each time the daily RSI got below 30 for Sol. Sure, some of these would have been really good times to buy before a short-term bounce, but most of the time, the price kept trending down afterwards. So given everything we've spoken about, how do you actually use the RSI in your strategy? Well, for long-term investors, buying gradually when the RSI is below 30 can provide good opportunities. Of course, that's assuming the asset has good fundamentals and is likely to go up over time. Selling when the RSI is above 70, however, is not such a good idea. Generally, buying when the RSI is below 30 and selling when it's above 70 is a terrible strategy. Don't do it. The RSI can stay above 70 or below 30 for longer than you can stay solvent. Instead, look for divergences between the RSI and the price to guide your trading decisions. In other words, when the price is trending in one direction and the RSI is trending in another direction. You can also trade based on RSI trend lines, but this is just for extra confirmation. So for the rest of this video, we'll now look at these 2 last important points, divergences and then a bit on trend lines towards the end. So let's begin with bullish divergence. This can tell you when to buy an investment. So let's look at bullish divergence with an example. Now, I'm sure you remember how panicked the stock market was in mid-2022, with all the talks of high inflation and recession. Around this time, many Wall Street analysts were calling for much lower prices based on a bunch of fundamental economic indicators. And while many of their bearish calls sounded very smart at the time, bullish divergence on the weekly RSI of the Nasdaq was telling investors that the lows were very likely already in because buy pressure was starting to outmuscle sell pressure. So here's that divergence explained. On the one hand, the price was making lower lows in 2022. That's technically a bearish sign since the trend was trending down. But if you look at the blue RSI on the bottom, you can see that it was making higher lows. So even though the price was going down, the RSI was actually going up. In other words, the average gain of up weeks over the past 14 weeks was bigger than the average loss of down weeks over those 14 weeks. And that served as a good indication that buy pressure was gradually starting to get stronger relative to sell pressure. Of course, the index didn't skyrocket higher straight after that. It took a few months to hang around the lows, forming a W bottom pattern, another sign that sell pressure was starting to wane. Also notice in the circle at the bottom that the weekly RSI got below 30 on the Nasdaq fairly close to the lows, but a few months before the low actually happened. And let's now look at the weekly chart of silver. Here you have lower lows on the price, as in the trend is still down, but higher lows on the RSI, as in buy pressure is getting stronger relative to sell pressure. Again, the circle at the bottom shows the RSI got below 30 close to the low, but a few weeks before it actually happened. And once the low was in, there was another W pattern, another sign that sell pressure was running out of steam. So we've seen how bullish divergence can help you spot bottoms in the price, or when the trend changes from a downtrend into an uptrend. Well, there's also what we call hidden bullish divergence, and that's when the price is already in an uptrend, but has a pullback and could be more likely to then continue with the uptrend than to reverse into a downtrend. Here we have the Bitcoin one-day chart, which is clearly in a strong uptrend. But from around November 2020 through to December 2021, the uptrend slowed down for a bit of a halfway stop. At this point, Bitcoin was still making higher lows, but the question most traders would have been asking themselves was, is now a good time to buy the pullback, or could this pullback be the start of a much bigger drop? That's where the RSI could have helped. Notice how it was making lower lows while the price was making higher lows. In other words, sell pressure was getting stronger. But despite sellers throwing as much pressure as they could on the price, it still made a higher low. In other words, the sellers were getting stronger, but not strong enough to force the price down. That's what we call hidden bullish divergence, and it's a potential sign to buy the dip while the price is already in an uptrend. And here's an example of hidden bullish divergence on the Nasdaq. The price first makes higher lows, but the RSI makes lower lows. So despite sell pressure getting stronger, sellers still can't push the price lower. A dip buying opportunity, if you ask me. So we've covered bullish divergence, both the regular kind and the hidden kind, and these can tell you when to buy an investment. Let's now look at bearish divergence. This can tell you when to sell an investment. So here's the Bitcoin one-day chart in 2021. Notice how the price kept making higher highs until about April of that year. The trend was still up, which is usually bullish. But while the price was making higher highs, the RSI in blue was making lower highs. In other words, sell pressure was getting stronger relative to buy pressure. Now, this took a long time to play out before the eventual big move down in May, but each of those highs resulted in pretty big drops nonetheless, and more often than not, after 3 drives of bearish divergence, you might expect a bigger downside move as buy pressure eventually runs out of strength. Let's now zoom out to the 1 month time frame for Bitcoin. Here we have a slightly higher high on the price and then a lower high on the RSI. That was a signal that buy pressure was running out of strength relative to sell pressure. But it's not just crypto markets where you can find bearish divergence. Here's the Euro USD FX pair on the 1 week chart. As you can see, there are higher highs on the price, coupled with lower highs on the RSI. In other words, buy pressure is running out of strength. So what about hidden bearish divergence? Well, here's an example on the Bitcoin 1-day chart. In this case, the price makes lower highs, so the trend is still down. The RSI, meanwhile, makes higher highs, meaning buy pressure is getting stronger. Still, even with all that strength, buyers still couldn't get the price to make a higher high. This hidden bearish divergence would have been a warning sign for investors to potentially sell the rally. Let's now summarize all the different divergences on one page. For regular bullish divergence, the price makes lower lows, with the RSI making higher lows. This can signal a potential bottom in the price as buy pressure gains strength over sell pressure despite the price going down. Regular bearish divergence is the opposite. It's when the price is making higher highs while the RSI is making lower highs. This can signal a potential top in the price. Even though the price is trending higher, sell pressure is still getting stronger and buyers are starting to run out of steam. So moving on to the hidden variety of divergences, and we have hidden bullish divergence. This happens when the price is making higher lows and the RSI is making lower lows. This is a sign that an uptrend might keep going up after a pullback. Even though sellers are getting stronger, the bears still aren't able to make a lower low and reverse the uptrend into a downtrend. And finally, we have hidden bearish divergence. That's lower highs on the price and higher highs on the RSI. In other words, despite the fact that buy pressure is rising, the bulls can't get the price to make a higher high, and the downtrend is more likely to continue than not. Now, before using any divergences in your trading strategy, you first need to confirm a local low or local high on the price. With bullish divergence, for example, you can't say that it exists until the price has made a lower low and the RSI has made a higher low. But for a low to be formed, you need confirmation that it is in fact a low. So here's an example to explain what I mean here. As you can see, the price moved down with a couple of red candles in a row. Now, for a low to be confirmed, you need a candle close above the wick high of the candle with the lowest spike low. So here's an L to show the lowest candle, and the green candle closes above the wick high of it to confirm a local low on the price. Note, this doesn't mean the price can't go lower again, it just means that you are recognizing that a temporary low has been formed, and you can use that low to consider a divergence if there is one. Here's the second example. Remember, for a local low, we want to see a candle close above the high of the lowest candle. Here's the low, here's the wick high, and then here's the candle closing above it. And over here, we have the same thing. Low, wick high, candle close above it. Of course, when using regular or hidden bearish divergences, we need to confirm local highs to confirm the divergence. And here's an example. To confirm a temporary or local high on the price, you want to see a candle close below the wick low of the candle with the highest spike high. And here's what that looks like. Highest candle, wick low, candle close below it. Notice in this case that it took more than one candle to confirm a local high. That's because the first two candles never closed below the spike low of the candle with the highest spike high. And let's look at a second example to drive this concept home. Remember, you want to see a candle close below the wick of the candle with the highest spike high. And in this case, you got that on the very next candle. High, wick low, and a candle close below it to confirm the high. A bit later on, the price made another local high, and in this case, the green candle made the highest high. And it took two red candles for the price to close below that green candle's low. But at the end of the day, traders use their own judgment to confirm what is or isn't a local low or high. If you'd like to use your own judgment, I would recommend you revisit the earlier video on lines and candlestick charts, as this will help you devise what's likely to be a low or high based on candlestick structures. For example, a bullish engulfing candle might signal a local low, or a bearish engulfing candle might signal a local high. To wrap this video up, here's one more example of the Bitcoin 1 week chart. Except this time, we can draw a trend line on the RSI to help us decide whether it's time to start buying or selling. Just like the price, you can draw trend lines on the RSI or any other similar indicator and incorporate that into your analysis. So in early 2019, Bitcoin's weekly RSI broke this downward trend line. And as you can see, this would have been a great time to buy Bitcoin. Notice too how the RSI got below 30 before it broke the trend line, another sign that sellers were getting exhausted. Here's another example later on in the year. This one didn't work out quite as well, but the price still had a decent rally before the COVID drop a bit later on. It then took another 3 years for Bitcoin's weekly RSI to break another downward trend line. Based on where the Bitcoin price is now at the time I'm recording this, that would have been a pretty good time to buy Bitcoin too. Again, the RSI breached the 30 oversold level before breaking the downward trend line, a good sign of peak seller fear and exhaustion. So all in all, using diagonal trend lines with the RSI can provide you with extra confirmation of whether to buy or sell. That's the end of this video, and here are the key takeaways. Number 1, the RSI measures the speed and distance of price movements. 2, the RSI ranges between 0 and 100 and shows the relative strength of buy pressure versus the relative strength of sell pressure based on average gains over average losses. 3, the RSI can stay overbought, which is above 70, or oversold, which is below 30, for a long time, so it's not always a good buy or sell signal. 4, a weekly RSI below 30 can in some cases be a good long-term buy signal if the asset has good fundamentals. And finally, number 5, for best results, look for RSI patterns and or divergences between the RSI and the price, with the candle closes for confirmation of divergences. So that's it for the RSI. This was a bit of a longer video, but I hope you now have a good understanding of the power of the RSI indicator and how to use it in your strategy. Next up, we'll move on to Bollinger Bands. This is an all-round indicator, and if used correctly, might just be the only indicator you'll ever need. So thanks for watching, and I'll see you in the next video.